Anatomy of a meltdown. The visual story of the 2008 financial crisis. The 2008 financial crisis was not a singular event but a decade-long accumulation of risk, fueled by cheap credit and complex financial engineering. When the housing bubble burst, it revealed a global financial system built on a foundation of toxic debt and regulatory neglect. Here's an interleaved sequence illustrating how the crisis unfolded, from the suburbs to Wall Street, and its eventual global impact. 1. The roots, the housing bubble and subprime lending. The crisis originated in the United States housing market. Following the dot-com bust of 2000, the Federal Reserve kept interest rates low, fueling a rapid expansion of credit. This led to a belief that real estate values could only rise. During this period, lending standards eroded significantly. Financial institutions aggressively marketed subprime mortgages, high-interest loans given to borrowers with poor credit histories or insufficient income, often with teaser initial rates that would later reset to unaffordable levels. This environment created a speculative frenzy. Millions of Americans became homeowners, often assuming they could simply refinance if payments became too high. The entire system was predicated on the assumption that housing prices would continue their upward trajectory indefinitely. This image captures the surreal optimism and fragility of the housing boom. We see an endless suburban landscape under a glowing, artificial sunset. In the foreground, giant, translucent dice labeled subprime loans are being stacked by faceless bankers, emphasizing the precarious nature of the boom. Financial engineering, Wall Street and the toxic asset pipeline. The defining characteristic of the 2008 crisis was how these localized, risky subprime mortgages were repackaged and sold globally to major investment banks. Wall Street bundled thousands of these mortgages into complex financial products known as mortgage-backed securities, MBS. These securities were then sliced and repackaged into even more complex instruments called collateralized debt obligations, CDOs. The critical failure here was the role of credit rating agencies, like Moody's and S&P, which routinely stamped these risky pools of debt with their highest AAA rating. This false designation assured pension funds, hedge funds, and other global banks that these assets were safe, encouraging widespread investment. Furthermore, institutions bought credit default swaps, CDs, essentially insurance policies, betting against the mortgages they were selling, creating a massive, unregulated web of counterparty risk. Image 2. The alchemy of debt. This image visualizes the complex and secretive process of financial alchemy. We move from the sunlit suburb of image 1 into a dark, subterranean vault. A complex glass apparatus receives the tiny, glowing stylized houses, the mortgages, from the bubble. Below, a crushing mechanism compresses this raw material into cold, glowing, geometric blue cubes, the CDOs. The light here is cold and artificial, contrasting sharply with the warm, artificial glow of the bubble in image 1. The collapse, September 2008. The bubble began to deflate in 2006-2007 as housing prices fell and teaser rates expired. Defaults surged, and the AAA-rated CDOs became virtually worthless, creating a $1 trillion hole on bank balance sheets. The crisis entered its terminal phase in September 2008. On September 7, the government seized mortgage giants Fannie Mae and Freddie Mac. 1 week later, on September 15, 2008, investment banking giant Lehman Brothers filed for Chapter 11 bankruptcy protection. The US government's decision to let Lehman fail, contrary to previous bailouts, like Bear Stearns earlier in the year, caused global credit markets to freeze completely. Trust evaporated, banks stopped lending to each other overnight. Simultaneously, the insurance giant AIG, which had written billions in credit default swaps, faced imminent collapse, triggering a massive federal bailout. Image 3. The fall of Lehman Brothers. This documentary-style photograph captures the human reality of the September 2008 collapse. We are outside the Lehman Brothers headquarters in New York City. The sky is overcast and grey, carrying the bruised purple tones established in previous images. Dispirited employees, emphasized by the cold, harsh light of the breaking day, leave the building carrying their entire careers in standardized cardboard boxes. The iconic blue logo is visible, marking the end of an era. The aftermath, Great Recession and regulatory response. The collapse of Lehman Brothers triggered the Great Recession, the most severe global economic downturn since the Great Depression. Stock markets plummeted worldwide, global trade contracted, and millions lost their jobs and homes. Governments and central banks responded with unprecedented intervention to prevent a total systemic collapse. In the US, this included the Troubled Asset Relief Program, TARP, a $700 billion fund authorized by Congress to purchase failing assets and inject capital into banks, often summarized as too big to fail. Central banks also slashed interest rates to near zero and engaged in quantitative easing. The crisis led to a major overhaul of financial regulation, most notably the Dodd-Frank Wall Street Reform and Consumer Protection Act, 2010, aimed at increasing transparency and accountability in the financial sector and creating the Consumer Financial Protection Bureau, CFPB. Image 4. The Desolation and Descent. This final image closes the loop, returning us to the suburban landscape first seen in image 1, but transformed into a landscape of desolation. The sky retains the cold, bruised, oppressive grey-purple light established during the collapse, image 3. The identical homes are now boarded up and abandoned. In the foreground, a family sits on the curb, their belongings in plastic bags, embodying the foreclosure crisis. Across the street, a line of protesters faces stoic riot police, holding signs reading, "Foreclosure Crisis," and "Where is the bailout?" visualizing the deep social and economic unrest that followed the collapse. Data Visualization Suite, the 2008 crisis. This sequence uses a consistent, sterile data visualization aesthetic, white background, precise graphs, stark colors, to illustrate the magnitude of the economic shock. 1. The housing bubble, quantitative view. This graph provides the hard data behind the idealized suburban expansion shown in image_0.png. It tracks the rapid inflation of housing prices and their subsequent collapse. The Case-Shiller Index serves as the definitive measure of the US housing market. The data shows a slow rise in the early 2000s, followed by a speculative frenzy, fueled by subprime credit, that caused prices to double in 5 years. The peak occurred in early 2006. When the bubble burst, prices fell faster than they had risen, erasing trillions of dollars in household wealth and triggering the initial wave of mortgage defaults. The CDO machine, structural view. This flowchart breaks down the complex financial engineering illustrated conceptually in image_1.png. It explains how the toxic assets were created and, crucially, how they were misrated. The chart shows the transformation of thousands of high-risk, red, subprime mortgages, the input from image 1, into a pooled asset. This pool is then sliced into tranches. The financial alchemy occurred when the rating agencies, e.g., Moody's, S&P, relying on flawed models, designated the majority of this risky pool as senior, AAA rated, the green slice. This AAA stamp was essential, as it allowed regulated entities, pension funds, etc., to buy the debt, thereby injecting the toxic risk into the global financial bloodstream. The market crash of 2008, temporal view. This graph quantifies the sudden, catastrophic loss of confidence that paralyzed Wall Street, the immediate financial consequence of the events visualized in image_2.png. The chart tracks the performance of the S&P 500 index throughout 2008. The market had already been volatile due to the Bear Stearns rescue in March. However, the failure of Lehman Brothers on September 15, 2008, registers as a distinct, near-vertical drop. The index plummeted as the interbank lending market froze and investors panicked, wiping out years of market value in a matter of weeks. The aftermath, the Great Recession, macroeconomic view. This final dual-axis chart visualizes the economic devastation that followed the financial collapse, providing the data context for the social unrest shown in image_3.png. The graph tracks two critical economic indicators from 2007 to 2010, federal funds rate, dashed orange line. This is the emergency monetary policy response. The Federal Reserve, led by Ben Bernanke, aggressively cut interest rates from over 5% down to near zero, or -0.25%, by the end of 2008 to restart lending. US unemployment rate, solid blue line. This is the real-world consequence. Despite the drastic rate cuts, the economy contracted violently. The unemployment rate began a relentless climb, doubling from 4.6% at the start of the recession to a peak of 10% in late 2009, defining the Great Recession.